Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back with another strategy session on the market at large and how we can use closed-end funds to improve our investing. And that is my cat being an asshole in the background. This is an unedited video like you hear, so who knows what else you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I mean, you honestly just heard me cuss on a video. So I walk in limited company and sometimes I walk alone. Normally, I get into this, quite honestly, this longer drawn out explanation about what happened over the past week and what our reminders are and why I like closed-end funds and then the methodology and the strategy and the code and how we invest. And quite honestly, I'm going to skip all of that this week. Um, I wanted to make this more like a fireside chat, but and I realize it's not. I wanted to make it more of a kind of general conversation or how I might explain it to somebody else. And thankfully, a friend of mine posted something on Facebook asking about if I agreed or asking her group at large if we agreed with Robert Kiyosaki's standpoint or Robert Kiyosaki's take of this being the next great recession and the best time to buy stocks. And I'm not going to read you exactly what I posted on our timeline, but I want to summarize that, but also just kind of talk you through my rationale. A couple years ago, Webster's got caught redefining the word recession, and we can argue about why they did that, but they got caught redefining the word recession to make people in power look better. Um, and honestly, I think we've been in a recession slide a while. It's kind of hard not to be there when the Fed has been manipulating the economy as it has. We saw record low interest rates, followed by uh, really crazy, out of control Federal Reserve printing of money, followed by crazy inflation or the devaluation of money from all the money they printed, um, to which they tightened rates as a way to control how much money there was in the market. So we've had record high inflation followed by record high rates. And their goal of what the public perceives is that inflation hits at 2%. That's their goal. But really, inflation sits about 4% on a good year. So, with the Federal Reserve tightening the budget or really tightening the economy and quietly printing more money and quietly buying more bonds, um, it's hard to hit anywhere but a recession. And then you factor in the jobs report from a month ago where they got caught, where the Labor Department got caught falsifying the jobs report, which the jobs report as is a faulty document. It's not real-time data. It's averaged estimated data. The jobs report is the labor market as seen in hindsight. And I'm sure there's current data filtered in, but it's not all current data. It's not even all accurate data. It's the general season jobs report. You have all these different sources of info, but they also factor in part-time jobs into that. So you see more jobs during holiday seasons, you see more jobs during summer. And on the most recent jobs report, it's really bad data. Um, and I'll show the screen in a minute, but the jobs report was 142,000 jobs were added, which is low. But full-time positions plummeted by almost 500,000, and part-time work surged more than 500,000, with it almost being break even between the new terminology of foreign of native born U.S. citizen, which doesn't make sense. But you have native born U.S. citizens and foreign born workers, which could be illegal or for any number of reasons inside the U.S. And as one economist or pointed out, that's not growth. That is impoverishment. So with an economy that does not favor in America and a slowing economy, not just, hey, we're tweaking the regular jobs report and adjusting it for months where we don't see a holiday, not even the regular tweaks, right? If you think the jobs report is accurate, you need a wake up call, something greater than this. I mean, they are giving us bad data and they are giving us really skewed and twisted data. But even as is, in this twisted, skewed, limited data, the data is bad. And we saw that in the market at the end of the week. So I think we're on a slide into a recession. We really can't be anywhere else, right? And several different groups back that idea of what I've talked about before. You've got JP Morgan talking about that. You've got the Contrarian Outlook team. Trump said if things don't change, we're headed for a pretty steep recession next year. So it's kind of somebody else. It's Are we heading for a soft landing or a hard landing? Or as one economist recently put it, are we heading for no landing at all? In that we're not going to see a recession. It's another goalpost move. It's nobody wants to call it like it is. The Federal Reserve has been tinkering with the economy, and they're the problem. Now you've got policy stemming from the top down that's not helping anybody. But the Federal Reserve has been unchecked for a while. We don't need the Federal Reserve. The Federal Reserve is screwing us all. But as that's the system we have to play. So recession is imminent. And at least from my standpoint, and that's how we're investing. So unless Webster redefines the term again, like the other economy article I've read last week of how they're redefining the term recession, um, the current the current market is still riding a greed wave. We had the we had that weird dip with the Japanese yen, um, and now we have the labor market dip, and there are a ton of people that are fearful. And even then, we're still higher than where we've been. It's somewhat dependent on sector, but we're still higher than where we've been. And if you look at just generalized data, so in a recession, bond prices go up. Maybe the dividends dip a little bit because the economy. Stock prices fall. So you've got bond prices and real estate and um, CLOs and loans that are projected to go up. You have stocks that are projected to go down, and currently stocks are still riding a high. So I agree with Kiyosaki in that I think recession is coming, but I disagree with Kiyosaki in that I don't think it's the time to buy stocks right now. And because of that, we're still buying bonds, and we're prioritizing high yield, consistent income bonds. But we're also prioritizing dividends, and that's where closed-end funds still have an advantage. Pick a great economy or a horrible economy, closed-end funds will still give you a better advantage than buying single stocks in general or single bonds in general. So uh, let's see. Before I get into anything else, I mean, you've heard my rationale. Let me at least just share the article with you, and then we'll get into the week. So if you didn't see this, this is what MXM is reporting. And then if I click on this, it'll take me to the X profile. But the highlight, um, I mean, by all means, pause it and read it. Then I'm going to scroll down and you can hit the key details. Yeah, native born American just doesn't. And I'm pausing to let you read. So you can pause it and read what you want. So if we go to, as I close tabs, so if we go back to the closed-end fund master, everything got updated today, which is why it's out of order because the last thing I was doing was um, filtering out the targets again. So in ranking by alpha, everything got updated today. Um, and the gray system, the gray colors, there we go. I mean everything. So when we rank by discount, we rank by target. Price of share relates to what we currently own. Um, Cost of share current relates to what we currently own. So we own everything in dark blue and light blue. Green is we track for any number of reasons. Purple comes recommended by somebody at some point, which these get updated. So we're prioritizing monthly. KY is about $2 more than we was about $2 more. Now it's about $1.70 more than where we bought it. So now we have this list. So everything has a significant discount. Everything's monthly. So now we're going to prioritize yield. So if we look at 9% plus, with the exception of this one, because it remains the greatest discount. This is the short list, but we're going to sort it further. I don't think it's the time to buy stocks. I still think it's a bond. We're best served pursuing bonds. So you could lump bonds, loans, CLOs, real estate, all in that as well. So utilities, we missed the boat there. I mean, gosh, if I'm not paying 1171, I'm certainly not going to pay 1229. This is a bond company that, yeah, it's assets abroad, but it's bonds and so much more. It's bonds and rare minerals and gold and crypto and other closed-end fund ownerships. It's a activist, it's a shareholder prioritized activist closed-end fund list, and that they're fighting for better shareholder benefits. I love that. This is bonds in a mix. FCO is high income bond, utilities, technology, stocks, mixed stock portfolio, good stock portfolio. Same thing, high fixed income, just at the other end of the pendulum from FSCO. There we go. We have stocks, 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 and real estate. So all four fit the moniker. Bonds, high fixed income bonds. I mean, really, of what the targets are over here. So you get high fixed income with FSCO or CIF, bonds in general with BRW plus just different assets allocated. But HFRO is all real estate, to the point where they have bonds and loans for real estate, but it is all real estate. So where would we go? Well, I'm going to stick with the prioritizing the bonds. So as tempting as this is, and you could lump it into the same thing. I mean, of the money we have, we just bought another round of bonds, so we're not going to buy right now. If we bought anything, we would wait till the end of the month, or maybe we would sell some funds off our individual list. But that's not right now. So if we were buying Monday, and we're not, if we were buying Monday, what would we buy? Well, if you had your druthers, yeah, we would buy all four. This price is normalized, or we'll say leveled. It's been steady. The discount's a little less than it was last week, right? Week before, about the same. It's really about the same overall, but it seems to finally have leveled. And in a lower rate market, I think it'll come back. You could say the same for all four. So in a perfect world, we would buy equal shares of all four. But that doesn't allow me to be beholden or be accountable to our own strategy. So if we're going to prioritize high fixed income bonds, that means we have to eliminate this and we have to eliminate that. And that leaves us with these two options. So if we could, we would buy equal shares of both. And we really get opposite sides of the money pendulum. FSCO is their own lender. Um, gosh, 2.3 billion in assets, super high fixed income strategies, corporate bonds, all American company. They are their own internal lender. I love that. Then you have CIF, which is the same thing, except on the other end of the finance pendulum swing. It's almost entirely US investments, super high fixed income strategy, small corporate bonds, right? So you get like 2.3 plus, now you have 33 million, 35 million plus, and you cover all aspects of the pendulum on high fixed income. And that's ideal. Um, of what we own, let's see, of what we own, I think it is like 1.7235. Maybe I'm missing or I'm confusing. 1.7375. Close. What we currently own, so if we had our druthers, then yes, we would pick up 100 shares of both. Kind of consistent buying over time. The dollar cost averaging, I guess you could say, but not lump summing everything at once. Um, but if we only had so much money, then you only have so much money. Like right now, we've got $74. We're not buying on Monday. But if we bought, we would buy either of these. Um, and that's investing based on current strategy with long-term game planning and playing the market in an environment where it's bigger than now. So strategy being, so in the current rate market with the horrible jobs report, uh, you have inflation rising, and you have the Fed behind the game, I believe, which I mean they've manipulated the economy for years, but you've got the Fed all but saying they're going to cut rates. So when the Fed cuts rates, everything should do better. Everything should do better, right? It makes people happier. It makes people more confident. In theory, they have more money to play with, even though nothing's really impacted their day-to-day, month-to-month paychecks. But you have more money at play. But in a recession, if we see beyond the September rate cut and beyond it's like 10 basis point cuts that somebody's predicting now, between now and the same time next year, if we see beyond that, you still have a lot of groups predicting recession, and I don't see how we don't have one with the Fed controlling things as they are. Um, Super high rates, cut, super crazy super high rates, or at least ramped up, not so much super high, I guess, because other generations have had higher, but raised quickly, held on too long, and also held on too long to now finally cut rates in the midst of further inflation and this crappy jobs report. Um, I don't see how we have some sort of how we don't have some sort of recession. So in the event of a recession, regardless, interesting that my yield would disappear. Maybe that's because that went away. Um, Train of thought, random occurrence. In the event of a recession, so we have stocks on their high coming off the recent or coming off the current greed trend. The Fed cuts rates, it's just going to send everything higher, and it's going to make people happy and send everything higher. Then we get further warning of a recession, and stocks will drop. And if we hit a full announced recession, then stocks will drop. Bond prices will go up. Dividends will either stay the same or drop. And I'm hoping our closed-end fund dividends stays the same or rises, um, or increases, whichever the right word is. And then we're left with a quandary. Do we keep the funds long term, knowing that they're going to arc back down at some point, and pay an amazing dividend all the while? We sell them high, buy something else low, ride the next wave, sell that high, right? So, but that's a problem for later. So playing the game as it is, with the Fed cutting rates, bonds. With recession coming, not stocks. Current environment, riding a greed cycle, not stocks. I think the current fear and greed index is neutral, but everything is still higher than it was 2 months ago. So I have no desire to pay more for something than I need to. So I think Kiyosaki's right in a sense that recession's coming. I think he's a little early to the party, but at the same time, he and I are playing with different money. So on my end of things, it's still very much a bond. It's a bond buying environment. And when the recession fully starts, whether it's announced or they move the goalpost again, when the recession really starts and stocks drop, that's the time to buy stocks. And still not individual stocks, closed end fund stocks, because you can rake with closed end funds. Better buy in, better access, less risk, crazy dividends, and just less money invested overall. I mean, if you're going to spend $1,000 investing into a couple shares of Microsoft, or I mean, it's like $40,000 maybe to invest in one share of regular Berkshire Hathaway. I can pick up Berkshire Hathaway and a lot of other stuff in a closed-end fund for under $10. And Berkshire Hathaway doesn't pay dividends. I can buy Berkshire Hathaway and a lot of other fun stuff in a closed-end fund and buy a ton of it, get a ton of shares of it, right? And then have amazing dividends pay out the rest of my life. So why not closed-end funds? So, but the game right now is bonds. You're looking forward, and the recession, when the recession hits, that's when it's time to consider buying stocks. But for now, it's a bond game. And that's all I got. I'm going to leave it there. So I hope you have a great week. I hope everything falls in your favor. And if you need advice on strategy, if you want a different take, a different view, or just somebody to talk to, by all means, comment on the videos or come find me on Facebook at the Navigate Your Finances page. I wish you a great week, and I will see y'all later. Bye-bye.